Hey, welcome back to another episode of SIE Exam with InsuranceTestHelp.com. This is going to be a quiz, a practice exam for the SIE, Securities Industries Essential Exam. Some of you like to call it the SIE. I found when I took the SIE that I over-prepared. I was really nervous about it and just kind of psyched myself out maybe a little bit and did a little bit of over-preparation. So here we go. Study it. If you know all of these, then I think you're probably good to go. Let's go. The thing with the SIE is just that it is so comprehensive. I think that's what my psych-out was about. There's just a lot of material to get through. We have several videos on the SIE exam to help you get familiar with it and get all the details that you need to pass it. It's basically just knowing a little bit about a lot of different things. So if you're having any trouble with it, check out those videos. All right, right into the first question. What is the term for an economic downturn that lasts for 2 consecutive quarters? A, decline, B, recession, C, depression, or D, trough? I would, if you haven't taken economics, if you're taking economics in school, you could be great on a lot of these, especially if you took accounting, because there are questions on basic accounting principles and there are questions on basic economics. If you know both of those, you've got a head start. If you don't, I would know the economic downturns. I would know the economic cycle. I would know the what sort of things are defensive and cyclical. But for this one, you have to know what is the difference between obviously these 4 topics. So the answer here is going to be a recession. Be sure you also know what a depression is, just in case there's a twisty turn on your exam. Don't know what exam you're going to get because they're randomized. But I would be fairly certain you're going to see something on some sort of economic cycle. Okay, next up, Securities Exchange Act of 1934 established A, the SIC, B, FINRA, C, the Federal Reserve, or D, the SIPC. I would know what every single one of these is and when they were established. You need to know what the Act of 33, the Act of 34, basically just know all of the basic acts and basically what all of these parts of the securities industry do specifically. So for this one, it's going to be the SEC. I would know exactly what the SEC does, and I would know the difference between the SEC and FINRA. Both have different roles and different responsibilities, so I would make sure that you just know what they both do. Next question. The amount of stock that a corporation is allowed to issue is called A, outstanding stock, B, issued stock, C, treasury stock, or D, authorized stock. So in this case, it's D, authorized stock. This is the amount that they are allowed to issue. It's the amount that they put in there when they did their offering. I would know the difference between all of those, what treasury stock is, what issued stock is, what outstanding stock is, and what authorized stock is. I would also know the difference between what a secondary offering is, as well as a shelf offering, because those are often on the exam. What is the maximum loss for a buyer of a call option? A, the strike price, B, the premium paid, C, the difference between the strike price and the market price, or D, unlimited. There are not going to be a lot of questions on options. There might be a few. So the maximum loss for a buyer of a call option is going to be the premium paid. Obviously, the worst case scenario is the call expires worthless and you lose the premium paid for it. So, and you are a buyer of a call, you do not have to exercise it. So the maximum loss for the buyer of a call is the premium that they paid to get it. Bonds with longer maturities tend to have A, lower price volatility, B, higher price volatility, C, higher coupon rates, or D, more liquidity. Correct answer here is going to be B, higher price volatility. The longer the time, the more things can happen. So the more uncertain the future is, the longer it is. Treasury bills are quoted A, on a discount yield basis, B, in 1/8 dollar amounts, C, on a dollar cost averaging basis, or D, on a discount rate. The correct answer here is going to be A, on a discount yield basis. Obviously, T-bills do not pay interest. You just get the face value, the par value back when you cash it in. So they are going to be sold at a discount. I don't know if you need to know what type of discount. I would just know that T-bills are sold at a discount and that they do not pay interest. I would for sure know that. If interest rates rise, bond prices will generally A, rise, B, fall, C, remain unchanged, or D, become more volatile. If interest rates rise, bonds fall. So we know that they have an inverse relationship. So that is important to know. It probably will be presented in some way, shape, or form on your exam. Maybe not this simply, but know that they have an inverse relationship. Which of the following investment vehicles is a direct participation program, DPP? A, mutual fund, B, real estate investment trust, REIT, C, limited partnership, or D, exchange traded fund, ETF. It's going to be C, a limited partnership. I don't know how many questions you're going to have about DPPs. Mostly that, that they're just a limited partnership where you directly participate in the program as opposed to something more basic like common stocks and preferred. It's just a different investment vehicle where you form a limited partnership and there is someone who manages it, not you, that takes care of the investment vehicle for you. Which statement is not correct concerning mortgage-backed securities? GNMA, FNMA, and FHLMC are all fully backed by the federal government. B, interest received is subject to federal taxation. C, GNMA is a government-owned corporation. Or D, GNMA, FNMA, and FLMC will all hold FHA and VA loans in their portfolio. Look out for the questions that are the accepts and the not corrects. The only one in this instance that is not correct was A. Ginnie Mae, GNMA, is the only one fully backed by the federal government, and that is the one that for some reason they really want you to know on the SIE exam. So know that Ginnie Mae's are fully covered by, fully backed by the full faith and government of the United States, and I think you'll be all right because that's really going to be the only one that they really want you to know all the ins and outs of. An investor wants to invest in a fund that pays a fixed return and has a maturity date. What type of fund should they choose? A, mutual fund, B, unit investment trust, C, exchange traded fund, or D, a hedge fund. So the key phrase here was actually the maturity date. So it's going to be a unit investment trust. That is something that has a maturity date. It is passively managed. Obviously, they just buy the stocks and set them in there. Knowing if somebody wants a fixed rate of return and they want a maturity date, you're talking about a UIT. A margin account allows an investor to A, purchase securities without paying for them. Wouldn't that be nice? B, borrow funds to purchase securities. C, trade only mutual funds. Or D, avoid capital gains taxes. So this is an example of where you can find that maybe there's one that's ridiculous and then there's one or two that you might think might be the right answer. But this is going to be B, borrow funds to purchase securities. That's what you're doing when you have a margin account. A client in a high tax bracket who wants tax-free income should consider investing in A, corporate bonds, B, treasury bills, C, municipal bonds, or D, money market funds. The answer here is going to be C, muni bonds. Whenever you see a high wealth investor looking for a tax sheltery thing to not pay taxes, it's going to be spun kind of like that. So you're looking for the answer that's the municipal bonds. The difference between the bid price and the ask price is referred to as the A, new asset value, B, best execution, C, public offering price, or D, the spread. So this one's going to be D, the spread. Some of those other ones weren't even real things. I don't know what the new asset price is. There's the net asset price. Certainly not that. So just be familiar that there may be some ridiculous on there and look for the one that makes sense to you. Often it's the very first thing that pops into your head. So it's going to be the spread in this case. What does Regulation T govern? A, the settlement of corporate bond trades. B, margin requirements for security transactions. C, the approval process of new IPOs. Or D, the annual reporting requirements for broker-dealers. It's going to regulate B, the margin requirements for security transactions. I would know what Regulation T does, and I would know what Regulation D for the private placements does. Those are going to be two ones where they're going to use that language with the regulation and the letter number. An individual convicted of insider trading may be subject to A, civil penalties only, B, criminal penalties only, C, both civil and criminal penalties, or D, no penalties if the information was shared publicly afterwards. Okay, the answer is going to be C, both civil and criminal penalties. You could go to prison and you could end up being sued by everybody that lost money on the stock that you gained on. So just know that it is both civil and criminal penalties and that they're kind of harsh. A registered representative who receives a gift from a client must report it if the value exceeds A, $50, B, $100, C, $250, or D, $500. This is going to be B, $100. You need to not be obviously taking really expensive gifts from others. And if you do, you have to report it. So there is a cap put in place to keep everybody on the straight and narrow. The maximum sales charge for a mutual fund under FINRA rules is A, 3%, B, 5%, C, 8.5%, or D, 12%. This is going to be C, 8.5%. I would know that that is the maximum that FINRA will allow. Even though in the real world, they're nowhere near that high, just know that you are in test world, and so the correct answer is going to be 8.5%. An investor writes a put option. If exercised, they must A, buy the underlying security at the strike price, B, sell the underlying security at the strike price, C, pay a premium to the option holder, or D, do nothing since selling puts is a risk-free strategy. So writing puts comes with a risk. It is A, you must buy the underlying security at the strike price. So you already received the premium. That's what you got when you wrote it and sold it. And so if it is exercised by somebody, you will be obligated to basically do what you promised when you wrote the put. An investor owns a security with a $1,000 face value that matures in 3 months. It only pays interest at maturity. The interest earned is not subject to state taxes. What do they own? A, Treasury bill, B, Treasury note, C, convertible bond, or D, Treasury bond. They own a T-bill. Treasury notes and Treasury bonds both pay interest. And the shorter term T-bill does not pay interest. It only pays it at maturity. So understand that it will be sold at a discount, and that you would basically, if you're buying something that did not have an interest that it was paying every quarter or every year, it's going to be a T-bill. Which type of retirement account is funded with after-tax dollars and allows tax-free withdrawals in retirement? A, traditional IRA, B, Roth IRA, C, 401k, or D, defined benefit plan. So the SIE is not going to go into any details about defined benefit plans and all the nitty-gritty. You really do need to know what a Roth is, though. and the difference between a Roth and a traditional IRA. So your Roth is the one that you use after tax dollars, and it's also the one that allows you to make withdrawals without having to pay the taxes, because obviously you already paid them. So Roth is a beautiful thing. I don't know if the government will get rid of it one day, but until they do, you should be using yours, of course, and also knowing exactly what the Roth does. A bond's current yield is calculated as A, annual interest divided by market price, B, market price divided by par value, C, annual interest divided by par value, or D, the coupon rate times the maturity. I don't know if you're going to have a whole lot of calculations on calculating bonds and their yields, but just in case you do, it is A, annual interest divided by market price. And just know the basics of calculating yield. I don't think you're going to have any complex on the SIE as far as calculating yield. That will be maybe on some more advanced exams, but on this one they just really want you to know the basics. So know how the calculations work just in case you get 1 or 2 questions on yield. A customer with a traditional IRA must begin taking required minimum distributions, RMDs, by A, age 59 and a half, B, age 62, C, age 70 and a half, or D, age 73. The answer is going to be D, age 73. I would know when RMDs kick in. I would also know when the penalties for withdrawal goes away. That was the trick slipped in there with the 59 and a half. So I would know sort of those birth dates on when that can happen, okay? A registered representative who wishes to trade securities for personal accounts must obtain permission from A, the SEC, B, FINRA, C, their employer, or D, the SIPC. The answer here is going to be their employer. They have to get permission to open an account that's not at that brokerage. They also have to get permission to work an outside job or an extra job. If you want to drive Uber, you got to ask your employer. There's also a couple other questions if you want to be involved in a private securities transaction. So when in doubt, if you have to ask somebody permission, it's probably the employer. In a 529 plan, the primary benefit is A, tax-deductible contributions, B, tax-free withdrawals for qualified educational expenses, C, guaranteed investment returns, or D, early withdrawal without penalty. So 529s are pretty cool. The answer is going to be B, tax-free withdrawals for qualified educational expenses. So you can take out whatever you need to pay your tuition or anything else that is involved in your college education. So know that the 529 plan just allows for qualified tax-free withdrawals. Which of the following is an example of a passively managed fund? A, index fund, B, growth fund, C, hedge fund, or D, money market fund. Correct answer here is going to be A, an index fund. It tracks an index. So it basically is just the vessel that carries all the stuff in the index. So it doesn't require the same amount of active management that some portfolios or some funds would need. So you would pick index fund if you were looking for a passively managed fund. What type of bond is backed by the general taxing authority of the issuer? A, corporate bond, B, revenue bond, C, general obligation bond, or D, convertible bond. This is going to be a general obligation bond is the correct answer. I would know for municipal bonds the difference between a general obligation bond and a revenue bond. Obviously, a revenue bond generates whatever they're giving it for is a revenue generator. So if you just kind of keep that in mind. So if you're building a new airport that's going to pay fees, you're going to build a new aquatic center where people are going to pay fees, that sort of thing is going to be a revenue producer. So that's going to be a revenue bond. The other ones are going to be general obligation bond. An income statement, A, lists the value of property, plant, and equipment. B, covers financial activity over a period of time. C, shows a financial position at a specific point in time. Or D, shows the performance of the company's stock. I would know basic accounting things: balance sheet, income statement. Income statement covers financial activity over a period of time, like how much money did you make this year. Some of the other options actually describe the balance sheet. The balance sheet would have where your plant and equipment was, and it would also be where you'd see a snapshot in time. So I would know the difference between balance sheet and income statement, and I would know the basics of what they both do if you're not familiar with sort of basic accounting. The break-even price for a buyer of a call option is A, the strike price minus the premium, B, the strike price plus the premium, C, the market price at expiration, or D, the price of the underlying stock. The answer here is going to be the strike price plus the premium. Obviously, you had to pay for the premium, making your break-even price higher than the strike price, because if you paid $3 for the premium, you can add $3 to the strike price, right? So just keep that in mind, that is going to add to your break-even price. It will be higher than the strike price. So just know that it is strike price plus premium gets you your break-even on a call. Which of the following is a long-term security? A, T-bill, B, commercial paper, C, warrants, or D, banker's acceptance. So this one was kind of easy because all the other choices were short-term. So the correct answer is going to be C, warrants. I don't know how many questions you're going to see on warrants, but it does seem to be something that they want you to know for test world, even though it is something you will rarely see in real world. Structuring is a technique to A, increase your bond yield, B, evade AML reporting requirements, C, reduce capital gains taxes, or D, diversify a mutual fund portfolio. So this is a money laundering technique, obviously. So the answer is going to be B, evade AML reporting requirements. Which of the following is considered a money market instrument? A, corporate bond, B, treasury bond, C, commercial paper, or D, municipal bond. So you're looking for the short-term one here, so the correct answer is going to be C, commercial paper. Which of the following securities is exempt from SEC registration? A, corporate bonds, B, initial public offerings, C, municipal bonds, or D, mutual funds. I would know the entire list of what is exempt with the SEC, so the correct answer here is going to be C, municipal bond. Which of the following best describes cash settlement? A, cash settlement may not be done in a margin account. B, the customer has 2 days to pay. C, the customer pays for the security on trade date. Or D, the customer must pay for the securities with cash. So this one was a little confusing. If you picked D, I'm sorry. The correct answer is C, the customer pays for the security on trade date. I think the meaning of the slide was that they paid with actual cash, and that wasn't really clarified. The correct answer is going to be the customer pays for the security on trade date. That is a cash settlement. When must a prospectus be delivered to investors purchasing a new security? At least 48 hours before the trade. B, no later than settlement date. C, within 30 days of the trade. Or D, only upon request. I will almost guarantee this one will be on your exam. The correct answer is B, no later than settlement date. I would know all of the dates regarding prospectus, red herring, and tombstone, and what they all do, because they're just favorites of them liking to slap on these exams. So I would know that when they have to deliver the prospectus, and it's not optional, obviously. What type of preferred stock may be exchanged for shares of common stock? A, participating preferred, B, callable preferred, C, convertible preferred, or D, cumulative preferred. I would know all of these bad boys. So the one that can be exchanged is convertible preferred. So just know that if they're exchanging it convertible, you're converting it. The bid price of a stock represents A, the price at which an investor can buy the stock, B, the price at which an investor can sell the stock, C, the highest price paid for the stock in a day, or D, the price set by the SEC. So you got to know your bid ask, And the question for bid is going to be B, the price at which an investor can sell the stock. Obviously, the ask is what you can buy the stock for. So just know that what the difference is and which one does what. Which of the following is a lagging indicator? A, average duration of unemployment, B, housing starts, C, average prime rate, or D, both A and C? Correct answer here is going to be D, both A and C. This is a read the full question tester one. So just make sure that if you did grab A, you were right, but the correct answer was D with both A and C. So just make sure that you're reading the full question and all of the answers so that you end up getting the best score you can get and above the 70, because as long as it's above that, you're passing. What is the primary difference between common stock and preferred stock? A, common stock provides fixed dividends, while preferred stock does not. B, preferred stockholders have priority over common stockholders in dividends and liquidation. C, common stockholders have voting rights, while preferred stockholders do not. Or D, both B and C. So hopefully after the last question, you picked D, both B and C. Obviously, when the order of liquidation, preferred stockholders sit above common stockholders, and common stockholders have voting rights. So just make sure that you understand the order of liquidation from the top to the bottom, and it also could be from the bottom to the top on your test, and understand that common stockholders have voting rights. What type of order guarantees execution but not price? A, limit order, B, stop order, C, market order, or D, good till canceled order? Correct answer here is going to be C, market order. They're going to fill it right away because you were not putting any limitations on it. So just know that it may not be executed at the price that you're hoping, but it will be executed. You will guarantee that it gets executed. A bond is selling at a premium when its A, coupon rate is lower than the market interest rate, B, yield to maturity is higher than the current yield, C, market price is higher than its par value, or D, market price is lower than its par value. C, market price is higher than its par value when it's at a premium, lower than its par value when it's at a discount. So just make sure that you know premium is higher, the market price is higher than its par value, and that you also understand what selling at a discount is. A brokerage firm must provide a customer with a risk disclosure document before A, opening a retirement account, B, opening a margin account, C, allowing mutual fund investments, or D, offering a fixed annuity. Correct answer here is going to be B, opening a margin account comes with additional disclosures that they're required to give to their customers. Non-systematic risk, A, can be reduced through diversification, B, affects the entire market, C is the same as purchasing power risk, or D, cannot be reduced through diversification. So you need to know your systematic and non-systematic risk. Non-systematic risk can be reduced through diversification, so A is the correct answer. Obviously, some of those others describe market risk or systematic risk, which is that you cannot diversify away from it and it affects the entire market. But for non-systematic risks, such as sector risk, political risk, currency risk, all of those can be diversified to protect yourself from them being such a big exposure of risk. Which market participant stands ready to buy or sell a particular security to keep the market liquid? A, broker, B, market maker, C, transfer agent, or D, custodian? So the answer here is going to be market maker. I would understand that a market maker stands ready to buy or sell a security basically at any time. A bond with a callable feature benefits A, the bondholder, B, the bond issuer, C, the bond trustee, or D, the credit rating agencies. The answer here is going to be B, the bond issuer. A callable bond benefits the bond issuer because they can yank it back if they need to, if interest rates have had a change and they want to reissue it. So they'll just call it, and so that callable feature does not benefit you as a buyer, it benefits the bond issuer. Which of the following is a characteristic of a zero coupon bond? A, it pays periodic interest payments. B, it trades at a discount to par. C, it provides dividend income. Or D, is it exempt from federal taxes? The correct answer here is going to be B, it trades at a discount to par. Zero coupon means just that, zero coupon, so there is no interest payments. Which of the following statements describes pump and dump? Obviously prohibited practice. A, trading ahead of customer orders. B, buying and selling a security among traders to create a high level of activity. C, purchasing a large number of shares right when the market opens. And D, artificially increasing the price of a stock by making positive statements that are false and misleading in order to sell the stock at a higher price. So this one's interesting because every single thing on that list was illegal. But the one that describes pump and dump is D, artificially increasing the price of a stock by making positive statements that are false and misleading in order to sell the stock at a higher price. Obviously, you're going to pump it up, then you're going to dump it. Prohibited and illegal practice. A stock that is highly sensitive to economic changes and tends to perform well during economic expansion is classified as A, defensive stock, B, cyclical stock, C, growth stock, or D, value stock. This is going to be B, a cyclical stock, as the market improves, as the economy goes into expansion. Cyclical stocks go with that and improve. So growing with the expansion is going to be a cyclical stock. A client who wants to invest in a fund that mirrors the performance of the S&P 500 should consider A, a hedge fund, B, a mutual fund, C, an index fund, or D, a unit investment trust. This is going to be C, an index fund. Index funds mimic whatever they are indexing on. So an index fund on the S&P 500 will mimic the S&P 500 and give you the results of that. So if you want to stick with that, buy an index fund. If the Federal Reserve is trying to stimulate the economy in a period of low inflation and an economic recession, it will A, increase the interest rate, B, raise the federal fund rate, C, buy bonds in the open market, or D, sell bonds in the open market. So the correct answer here is going to be C, buy bonds in the open market. You may not need to know the specifics of stimulating or slowing down the economy, but you are going to need to know the basics of what the Federal Reserve does and what the rates that the Federal Reserve charges. So I would go through whatever study material you are doing that has the Federal Reserve details. And if for some reason it doesn't have it, let us know. We'd be happy to make a quick video on it. If a company splits its stock 3-for-1, what happens to an investor who owned 100 shares at $90 per share before the split? They now own 33 shares at $270 each. B, they now own 300 shares at $30 each. C, they now own 150 shares at $60 each. Or D, they still own 100 shares, but at a lower price. Gotta know this one. They now own 300 shares at $30 each. So they got triple the shares, right? 3-for-1. But now the price has come down because it's now divided by the 3. So they've got 3 times the shares, but less because the price came down. It's a way to bring the price of a stock down when it gets too high. So just understand how stock splits and reverse stock splits work, because both of them are probably going to be on there, and if they're not, at least one of them is. Okay, we're at the end. How did you do? I hope you did awesome. So get ready for your SIE, and I wish you the very best on your exams. If there's anything specific you want us to work on in a future video, we would love to let us know. Please like and share. It just really helps our channel, and we look forward to seeing you next time. Thanks. Bye.